In this video, I will be explaining the BBA third semester subject Financial Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 4 first important short question is: explain gross working capital. Gross working capital is the total investment a company makes in current assets. Current assets include cash, inventory, debtors, receivables, and short-term investments. It represents all resources a firm needs to run day-to-day operations smoothly. Think of it as the full wallet a company keeps to meet its short-term needs. The higher the gross working capital, the more resources a company has to operate, but too much can mean idle funds that are not earning profit. Example: suppose a company has cash is equal to 50,000 rupees. Inventory is equal to 1 lakh rupees. Debtors is equal to 80,000 rupees. Then, gross working capital is equal to 50,000 rupees plus 1 lakh rupees plus 80,000 rupees is equal to 2,30,000 rupees. This 2,30,000 rupees is the total short-term resources the company has invested to run operations. Key points to remember: focuses on total current assets. Helps in assessing liquidity and short-term financial health. Higher gross working capital improves operational efficiency but may reduce profitability if excessive. Think of it as all the tools a company keeps in its toolbox to ensure smooth daily work. Next important short question is: to write a note on Lockbox system. Lockbox system is a cash management technique used by companies to collect payments from customers faster and reduce the time cash takes to reach the company's bank account. Instead of customers sending payments directly to the company, they send it to a special post office box, Lockbox, managed by the company's bank. The bank collects the payments, deposits them immediately, and informs the company. This speeds up cash inflow and improves liquidity. Example: a company receives payments from 500 customers across India. Instead of waiting days for checks to arrive and clear, the bank collects these checks from the Lockbox daily and deposits them. This reduces the collection period and allows the company to use funds sooner for operations. Key points to remember: reduces cash collection time. Improves liquidity. Reduces chances of check theft or delays. Widely used by companies with large volume of payments. Think of it as having a fast lane for incoming money, so the company can get cash quicker without waiting for it to arrive by post. Next important short question is: 3. Explain about concentration banking in cash management. Concentration banking is another cash management technique used by companies to centralize their collections and make cash available faster for use. In this system, a company sets up regional collection centers or local banks where customers deposit payments. These local banks transfer the collected funds to the company's main bank account, concentration account, on the same day or regularly. This centralization helps the company reduce idle cash and improve liquidity. Example: a company with customers across Mumbai, Delhi, and Chennai receives payments daily. Instead of all payments coming to the head office in Mumbai, each city has a local bank account where payments are deposited. At the end of the day, these banks transfer the collected money to the company's main account in Mumbai. This reduces the time cash takes to reach the head office and allows the company to use it quickly. Key points to remember: centralize cash collection. Reduces delay in fund availability. Improves efficiency in cash utilization. Ideal for companies with widespread customers. Think of it as collecting streams of water from different places into a single reservoir, so the company always has cash ready to use. Next important short question is 4. Define net working capital. Net working capital, NWC, is the difference between a company's current assets and current liabilities. It shows the short-term financial health of a business and its ability to meet day-to-day obligations. Formula: net working capital is equal to current assets, current liabilities. Example: suppose a company has current assets 5 lakhs rupees, cash, inventory, receivables. Current liabilities 3 lakhs rupees, payables, short-term loans. NWC is equal to 5 lakhs to 3 lakhs is equal to 2 lakhs rupees. This means the company has 2 lakhs rupee more in short-term assets than liabilities, so it can comfortably pay off its short-term debts and invest in operations. Key points to remember. Positive NWC firm can meet obligations easily. Negative NWC potential liquidity problems. Helps in planning cash flow, inventory, and credit management. Think of NWC as a company's short-term financial cushion, the more, the safer. Next important short question is 5. Management of cash. Management of cash is the process of planning and controlling a company's cash inflows and outflows to ensure that it has enough liquidity to meet its short-term obligations while minimizing idle cash. Efficient cash management is crucial because cash is the lifeblood of a business. Objectives of cash management. 1. Maintain adequate cash for day-to-day operations. 2. Avoid holding excessive cash, which can reduce profitability. 3. Optimize cash utilization to earn returns or reduce borrowing costs. Techniques for cash management. Cash budgeting, forecasting cash receipts and payments to plan for surpluses or shortages. Lockbox system, collecting receivables quickly to speed up cash inflows. Concentration banking, centralizing cash from different locations to manage efficiently. Example: a company expects 2 lakhs rupee cash inflows and 1,50,000 rupee outflows in a month. Using a cash budget, it can plan to invest 50,000 rupee surplus temporarily in short-term instruments rather than letting it sit idle. Key point: think of cash management as balancing between having enough cash to run smoothly and investing extra cash wisely to earn returns. Next unit 4. Long questions. First important long question is 1. Explain various methods for determination of working capital. Methods for determination of working capital. Working capital refers to the difference between current assets and current liabilities, and its proper estimation is essential for smooth business operations. There are several methods to determine the working capital requirement of a firm. 1. Percentage of sales method. This method assumes that current assets are proportionate to sales. A fixed percentage of projected sales is taken as working capital. Example: if projected annual sales are 50 lakhs rupees and historical data shows that 20% of sales are held in current assets, then working capital is equal to 50 lakhs rupees times 20% is equal to 10 lakhs rupees. Advantage: simple and quick. Limitation: does not consider fluctuations in costs, production, or credit terms. 2. Estimate of individual components method. This method calculates each current asset and liability separately. Current assets like cash, inventory, receivables, and current liabilities like payables are estimated individually. Example: cash requirement 2 lakhs rupees, inventory 3 lakhs rupees, receivables 5 lakhs rupees, payables 4 lakhs rupees. Working capital is equal to 2 plus 3 plus 5, 4 is equal to 6 lakhs rupees. Advantage: more accurate and realistic. 3. Operating cycle method or cash conversion cycle method. This method calculates working capital based on the time it takes to convert raw materials into cash from sales. Formula: working capital is equal to cost of raw material plus wages plus expenses times operating cycle 365 payables. Example: raw material cost 1 lakh rupees, wages 50,000 rupees, cycle 60 days, payables 30,000 rupees. Working capital is equal to 100,000 plus 50,000 times 60 by 365, 30,000 21,918 rupees. Advantage: considers the actual business cycle and cash flow timings. 4. Regression statistical method. Uses statistical tools and past trends of sales, production, and costs to predict working capital requirements. Advantage: scientific and precise for large companies. Limitation: complex and requires historical data. Conclusion: the choice of method depends on the size of the firm, nature of business, and accuracy required. Small businesses may use simple percentage methods, while large firms prefer operating cycle or component methods for better planning. Tip to remember: think of working capital methods as from simple to detailed. Percentage quick estimate. Component detailed check. Operating cycle realistic timing. Statistical data-driven science. This way, you can easily recall the methods during exams. Next important long question is: to explain and illustrate the utility and preparation of cash budget as a tool of cash management. Cash budget, utility and preparation. A cash budget is a detailed plan showing the expected cash inflows and outflows over a specific period, usually a month, quarter, or year. It is a crucial tool in working capital management, helping a firm ensure it has enough cash to meet its short-term obligations while avoiding idle cash. Utility of cash budget. 1. Ensures liquidity, helps the business maintain sufficient cash to pay wages, suppliers, and other obligations on time. 2. Prevents shortage and surplus. By forecasting cash, a company can plan borrowing in advance or invest surplus cash wisely. 3. Facilitates planning, assists in making informed decisions about operations, investments, and financing. 4. Cost control, highlights periods of excess or deficit cash, helping control unnecessary expenditures. 5. Improves efficiency, helps in managing receivables and payables efficiently. Preparation of cash budget. A cash budget can be prepared using the receipts and payments method, which includes opening cash balance, cash available at the start of the period. Cash inflows, cash sales, collections from debtors, loans, and other receipts. Cash outflows, payments to suppliers, wages, rent, taxes, loan repayment, and other expenses. Closing balance, difference between total inflows and outflows. Illustrative example. Month opening cash, cash receipts, cash payments, closing cash. January 8,000, 60,000, 53,000, 15,000. February 15,000, 40,000, 45,000, 10,000. March 10,000, 45,000, 50,000, 5,000. April 5,000, 40,000, 48,000 minus 3,000. From the above example, April shows a cash deficit of 3,000 rupees, signaling the company needs to arrange additional funds, either by borrowing or adjusting expenditures. Tip to remember. Think of a cash budget as a financial calendar, showing where cash comes from and where it goes. Like planning your monthly expenses at home, It ensures smooth operations without running out of cash. Next important problem is 3. From the following information, prepare a statement showing working capital requirements. Budgeted sales 10 rupees per unit to lakhs 60,000 rupees per annum. Elements of the cost per unit. Raw materials 3. Direct labor 4. Overheads 2. Total cost 9. Profit 1. Sales 10. It is estimated that A. Raw materials are in stock for 3 weeks and finished goods for 2 weeks. B. Suppliers will give 5-week credit. C. Customers will require 8-week credit. D. Factory processing will take 3 weeks. Working capital requirement calculation. We are asked to prepare a statement showing working capital requirements. Let's solve it step by step in a simple and easy way. Given data. Budgeted sales is equal to 2 lakhs 60,000 rupees per year. Selling price per unit is equal to 10 rupees. Costs per unit, raw material is equal to 3 rupees, labor is equal to 4 rupees, overhead is equal to 2 rupees, total cost is equal to 9 rupees. Stock and credit periods, raw material 3 weeks, finished goods 2 weeks, suppliers credit 5 weeks, customers credit 8 weeks, production time 3 weeks. Step 1. Calculate weekly sales and cost. Weekly sales, units, is equal to total sales divided by 52 weeks is equal to 26,000 units divided by 50 to 5,000 units week. Weekly raw material cost is equal to 5,000 times 3 is equal to 15,000 rupees. Weekly production cost, labor plus overheads, is equal to 30,000 rupees. Step 2. Calculate raw material requirement. Raw material in stock is equal to 3 weeks times 15,000 rupees is equal to 45,000 rupees. Step 3. Calculate work in progress, WIP. Factory processing time is equal to 3 weeks. WIP is equal to 3 weeks times production cost per week, labor plus overhead plus raw material portion. Raw material portion for WIP is equal to 3 times 15,000 equals 45,000. Labor plus overhead is equal to 3 times 30,000 equals 90,000. Total WIP is equal to 45,000 plus 90,000 is equal to 1,35,000 rupees. Step 4. Finished goods stock. Finished goods is equal to 2 weeks times cost of finished goods per week. Total cost is equal to 9 unit times 5,000 units is equal to 45,000 week. Finished goods stock is equal to 2 times 45,000 is equal to 90,000 rupees. Step 5. Accounts receivable, debtors. Customers credit is equal to 8 weeks times weekly sales, revenue. Weekly sales revenue is equal to 5,000 times 10 equals 50,000. Debtors is equal to 8 times 50,000 is equal to 4 lakhs rupees. Step 6. Accounts payable, creditors. Suppliers credit is equal to 5 weeks times weekly raw material cost. Creditors is equal to 5 times 15,000 is equal to 75,000 rupees. Step 7. Calculate net working capital requirement. Formula. Net working capital is equal to raw material plus WIP plus finished goods plus debtors, creditors. NWC is equal to 45,000 plus 1,35,000 plus 90,000 plus 4 lakhs, 75,000. NWC is equal to 6,70,000 to 75,000 is equal to 5,95,000 rupees. Answer. The firm requires 5,95,000 rupees as working capital to meet its operations smoothly. Tip to remember. Think of working capital as money tied up at every stage, raw material, production, finished goods, and sales. Credit from suppliers reduces the cash needed, while credit to customers increases it. Next important problem is 4. From the following information presented below, prepare a cash budget for the period from January to April. Abed Sir YouTube channel. Month expected sales, expected purchases. January 60,000 48,000. February 40,000 80,000. March 45,000 87,000. April 40,000 90,000. 1. The wages to be paid to workers amount to 5,000 rupees each month. 2. The bank balance on 1st January was 8,000 rupees. 3. Creditors are allowed 1 month credit. 4. Customers are given 1 month credit. Cash budget preparation, Jan-April. We are asked to prepare a cash budget. Let's solve it step by step in a simple and easy way. Given data. Sales and purchases. Month sales, rupees, purchases, rupees. Jan 60,000 48,000. Feb 40,000 80,000. Mar 45,000 87,000. April 40,000 90,000. Wages is equal to 5,000 rupees per month. Opening bank balance, 1st January, is equal to 8,000 rupees. Credit terms, suppliers 1 month, customers 1 month. Step 1. Calculate cash inflows. Cash inflows come from previous month's credit sales. Since customers get 1 month credit. Month cash inflow, from previous month's sales. Jan 0 rupees, no previous month. Feb 60,000 rupees, Jan sales. Mar 40,000 rupees, Feb sales. April 45,000 rupees, Mar sales. Step 2. Calculate cash outflows. Cash outflows include 1. Purchases, paid next month due to 1 month credit. 2. Wages, paid same month. Month purchases paid, last month's purchases, wages total outflow. Jan 0, DEC not given, 5,000 5,000. Feb 48,000, Jan purchases, 5,000 53,000. Mar 80,000, Feb purchases, 5,000 85,000. April 87,000, Mar purchases, 5,000 92,000. Step 3. Prepare cash budget. Cash balance is equal to opening balance plus cash inflow, cash outflow. Month opening balance, cash inflow, total cash available, cash outflow, closing balance. Jan 8,000 0 8,000 5,000 3,000. Feb 3,000 60,000 63,000 53,000 10,000. Mar 10,000 40,000 50,000 85,000 35,000. April 35,000 45,000 10,000 92,000 82,000. Step 4. Interpretation. Positive balance is equal to sufficient cash, Jan, Feb. Negative balance is equal to cash shortage, Mar, April. The company may need short-term borrowing. Tip to remember. Always add opening balance plus cash received and subtract all payments. Credit periods shift payments and receipts to next month.